What is the most significant expense Canadians face? It's not housing or food, it's taxes. In this video, you'll discover possible ways you could reduce your tax burden. So if you want to keep more money in your pocket, make sure you watch this video till the end. For the 2023 tax year, someone in Ontario who makes $100,000 will need to forfeit $26,347 towards taxes. That equals to almost $2,200 a month. But fear not, there are strategies to trim that bill. Let's begin with tax deductions. A tax deduction lowers your taxable income. A deduction is subtracted from your total income. Now you are taxed on the remaining income. The biggest tax deduction one can make is by contributing to your RRSPs or spousal RRSPs. The max one can contribute is 18% of the previous year's income. So if you make $100,000, $18,000 can be contributed and subtracted from your taxable income, meaning your new taxable income is now $82,000. Using a tax refund calculator, if your refund was zero, you would now receive a $5,550 refund. You may also do this with spousal RRSPs, but this is more of an income splitting strategy to reduce taxes overall as a family. Now there's a lot to consider with an RRSP, so for more info, check out the link in the video description below. Also, contributions to a registered pension plan may also be tax deductible. Other common deductions include support payments for a spousal or child, moving expenses, childcare expenses, union or professional dues, disability support, and even deductions for those who are considered northern residents. Now, there are other deductions you can take advantage of and more complex strategies like income splitting, the Smith maneuver, and tax loss harvesting, but everyone's personal situation will be different, so consult with a tax professional or financial advisor to ensure any strategy will align with your unique circumstance. The next way to reduce your tax bill is with tax credits. A tax credit works differently from tax deductions. Tax credits directly lower your tax owing. So if you owe $10,000 in taxes and you have a $1,000 tax credit, now you only owe $9,000 in taxes. Note that there are two types of tax credits, refundable and non-refundable. A non-refundable tax credit can directly reduce your taxes, but if your tax credits are more than what you owe, you will not get a refund for the difference. A refundable tax credit, on the other hand, will be given to you in full no matter how little income tax you owe, which may cause a tax refund. Let's start with non-refundable tax credits. One of the most common credits that every taxpayer is entitled to is the basic personal amount. The federal basic personal amount for 2023 is $15,000. There is also a basic personal amount for provincial taxes, which will differ depending on the province. No taxes will be owed when your taxable income is below the basic personal amount, and you will still benefit from this tax credit if you are above this amount. Another common non-refundable tax credit is the Canada employment amount. This is for anyone who reported employment income. The maximum you can claim is $1,368 for 2023. So if you made at least this, you'll be able to claim the full amount. Other common non-refundable tax credits include the home buyers amount for first-time home buyers, the digital news subscription tax credit, tuition tax credit, volunteer firefighters amount, charitable donation tax credit, medical expense tax credit, spouse or common law partner tax credit, eligible dependent tax credit, Canada caregiver tax credit, and the list goes on. If you want to see if these credits apply to you or any other credits, check out the all deductions and credits section at the canada.ca website. I'll leave a link in the video description so you can easily find it. Now let's take a look at refundable tax credits. The most popular one is the GST HST credit, which really isn't a tax credit that reduces your tax bill. It's a government payment like the Climate Action Incentive and the Canada Child Benefit. But to receive such payments, you'll need to file your taxes. An actual refundable tax credit is the Canada Workers Benefit for low-income families. Your credit will depend on marital status, province of residence, income earned, and eligible dependents. Other popular refundable credits include the Canada Training Credit, the Refundable Medical Expense Supplement, and the Multi-Generational Home Rental Tax Credit. Now, there are more refundable tax credits, but you'll likely see them more on a provincial level, like the Physical Activity Tax Credit from Newfoundland and Labrador, the Jobs Training Tax Credit from Ontario, and the Home Renovation Tax Credit in British Columbia. Also, with provincial provincial taxes, you may find other non-refundable tax credits and deductions you may qualify for. To find these and other provincial credits, check out the provincial and territorial tax and credits for individuals on the canada.ca website. I will also leave a link in the video description below for quick access. Another way to reduce your tax bill is by tax sheltering or deferring. Yes, the RRSP is a tax deduction, but really it's tax deferring and tax sheltering, meaning you will need to pay taxes on it eventually. But the purpose is that your portfolio can compound and grow tax-free, the sheltering part, and strategically withdraw when you're in a lower tax bracket, the deferring part. Also, RRSP contributions can prevent more government clawback on benefits you may qualify for. Now, what if you're buying your first home? One of the most advantageous accounts you can open is the FHSA. Not only are the contributions tax deductible and the gains are sheltered, but if you withdraw to purchase your first home, the withdrawals are tax-free. This makes this account one of the ultimate ways to reduce your tax bill. The only con is that it's only for eligible first-time home buyers. Another type of tax deferral and tax shelter is the RESP. Investments in this account grow tax-free, plus there's a grant up to $7,200. This account is for saving for your children's education. When they withdraw the gains and grants within the account, they will likely be in a much lower tax bracket than yourself, helping reduce the overall taxes owed. Next, the TFSA. This account is not tax deductible like the RRSP, but it's a more flexible, true tax sheltering account. All deposits, capital gains, and dividend income can grow tax-free and be withdrawn at any time with no tax implication. The only con is that there is a contribution limit based on your room available. With this account, as long as you got the room, you shouldn't be paying any taxes on any interest, capital gains, or dividend income. These accounts can be used for stocks, ETFs, GICs, high interest savings, and even cryptocurrencies in ETFs. And lastly, you should know about the principal residence exemption. When you sell a house, the gain on the sale is considered capital gains or business income if flipping houses. But if the house you're selling is your principal place of residence, you will not need to pay any taxes on the sale. Things do get more complicated when dealing with multiple houses or short-term ownership, so do your own research like always. Another way to reduce your taxes is moving to a different province. Each province will have different tax rates at different income brackets. Provinces like Alberta, Ontario, and Saskatchewan have lower tax rates for high-income earners, while BC and Ontario have lower rates for low-income earners. All of this is controversial though. The territories are not even mentioned, although they have the lowest taxes, because the cost of living outweighs the tax rates. BC and Ontario have high cost of living, and places like Quebec have the highest tax rates, but some of the lowest cost of living in the country. There are situations where it does make sense to move, but think about all factors before packing your bags.
Ebon's navigation would soon cost a price. He was knocked overboard and turned into ice.
Now, if you really want to save on taxes, the best thing for you to do is to own your own business. Even as a sole proprietor, this is where all the tax write-offs come in. Hiring family members, business use of home expenses like insurance, interest on the mortgage, home repairs, phone bills, electrical bills, and using your personal vehicle for your business. Additionally, you can reinvest profits back into your business. This reinvestment can be then claimed as an expense or capital cost allowance, lowering your overall taxes. Now, once your business income starts to be excessively more than you need, incorporating is the ultimate way to save on taxes. Keep your profits in the business and pay a much lower tax rate. For businesses that qualify for federal small business deductions, 12.2% in Ontario, 11% in BC, and currently 9% in Alberta. Larger businesses do have higher tax rates, but still way lower than individual tax rates. When owning a business, you can pay yourself enough to cover your own personal expenses, leaving your personal tax rate as low as possible. One last thing to consider is that these deductions, credits, benefits, tax laws, and regulations can change at any time. Whether you're an individual or business, you are encouraged to seek professional advice or refer to the Canada Revenue Agency for the latest and most accurate information tailored to your unique circumstance. Now, you realize getting a tax refund just means you overpaid the government. If you want to minimize the extra money you give to the government and maximize your paycheck, check out the video on the right of the screen. Thanks for watching. Until next time, keep making money moves. Peace.